Hi, and welcome to this presentation. My name is Griffin Bridgers. I am a tax and estate planning attorney with the law firm of Hutchinson Associates in Denver, Colorado. And I'm here today to discuss some of the proposed tax reforms that apply to grantor trusts. So this will be a brief overview of what you should know. This is a presentation that's geared towards wealth advisors, so tax attorneys, estate planning attorneys, CPAs, financial advisors, and insurance agents. This can be used by the end client as well, although the presentation and material may be somewhat technical. But regardless of the audience, I want to remind you that this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. So, if any of the situations discussed in this presentation apply to you, you should consult with your attorney and tax advisor. Before we jump into this material, it's important to note that all we're talking about are tax proposals. Nothing has actually been enacted as law. So why do we need to worry about this if it's not actually been enacted as part of a new tax law? Well, there's a couple reasons. One, reforms to grantor trusts in particular will generate a huge potential volume of organization and work that needs to be carried out by attorneys and advisors. Also, there may be a very short window of time in which to do so, because the effective date, as we'll see, will be when a new tax law is put in place. So because of that short runway, along with the sheer volume of work that will be necessitated, it's important to get a jump on this potential reform so that you can organize and coordinate efforts to inform clients of what could be coming down the pike, whether or not it actually does end up being reality. Some other reforms to consider, which shoehorn into the issues we're going to talk about today, are listed on this slide. One is a proposed change to the estate and gift tax basic exclusion amount. Currently, that amount is $11.7 million per individual. It was previously scheduled to sunset by 1/2 in 2026. However, the proposal would push that date up to January 1 of 2022. So that amount will be reduced by 1/2, but including an inflation adjustment for 2021. So that amount should end up around $6 million if that change is made. It's also important to note that there could be potential tax changes to the rates of tax that apply to non-grantor trusts. Notably, increases to the net long-term capital gains rate and the ordinary income tax rate could apply. It's also important to note that an expansion of the net investment income tax could affect trusts, as well as a high earner tax that's been proposed, which would be a flat 3% for retained income in an estate or trust, which exceeds 3% for any given year. In order to understand these reforms, it's important to understand what a grantor trust is, on a broad level and in the context of the proposed tax reform. So on a broad level, a grantor trust is simply a trust where either the creator of the trust or a beneficiary is treated as the deemed owner of trust assets for income tax purposes only. Now, a grantor trust can be revocable or irrevocable, but the consequence of this tax status is that the grantor or deemed owner will pay the income tax on all trust income instead of the trust itself paying income tax on the income generated by the assets it owns. And because of this special tax fiction, there's no income tax if a grantor and a grantor trust sell or exchange assets between each other. So the reforms we're going to discuss today only apply by their operation to irrevocable grantor trusts, and they'll change this treatment for income tax purposes and for gift and estate tax purposes, as we will see. Now, when should we start to worry about these reforms? Well, the current text of proposals says that the reforms will kick in on the date of enactment of two new sections of the Internal Revenue Code. Those sections are 2901 and 1062. Having looked at this date of enactment, it's helpful to break down the effect of these new laws by the timing of transfers, whether those transfers happen before the date of enactment or after the date of enactment. In terms of existing grantor trusts, those will only be affected to the extent any transfers are made after the date of enactment. So, existing grantor trusts that have no additional transfers made after the date of enactment will not be affected. For those existing grantor trusts to which transfers are made on or after the date of enactment, the new law will apply. Similarly, if a grantor trust is created on or after the date of enactment, any transfer to that type of trust will apply as well. Similarly, any sales or exchanges between the grantor and the trust which occur after the date of enactment will also be subject to the new law. Based on this analysis, it's easier to consider the scope of this tax reform not in terms of existing or new trusts, but instead based on the timing of transfers. So we can break down transfers into grandfather transfers or non-grandfather transfers. Grandfather transfers are those that happen prior to the date of enactment. There will be no change to the tax treatment of those transfers. However, non-grandfather transfers are those that occur on or after the date of enactment, and for those, the tax treatment will change. The following is a list of the changes to tax treatment that will apply to non-grandfather transfers, which can be made either by gift or by sale. For one, any non-grandfathered transfers that are held in a grantor trust will be included in the grantor's gross estate for estate tax purposes based on their date of death fair market value. Similarly, any non-grandfathered transfers that are subsequently distributed from a grantor trust will be subject to gift tax if the distribution is not made to the grantor or grantor's spouse. Also, if the grantor trust status terminates, this will also be treated as a gift at the time of conversion of the trust to a non-grantor trust. One unsettled issue is whether a non-grandfathered transfer itself would be treated as a completed gift, but allowance is given under the new law to subtract from the gift amount any prior amounts which were reported as taxable gifts. So for all intents and purposes, these first two reforms will cause the post-gift or post-sale appreciation in the value of assets comprising non-grandfathered transfers to be subject to estate or gift tax. Another change is that gain may be recognized on a sale or exchange between the grantor and the grantor trust. As we talked about in the very first slide, that is not the current treatment, and this type of sale or exchange is ignored for income tax purposes under current law. However, Code Section 1062 will cause that to be a recognition transaction for gain. However, loss may not be recognized because a grantor and a grantor trust will be treated as related parties. Just to clarify, when we're talking about these reforms, the text of the statutes look at the deemed owner. And as a reminder, a grantor of a trust can be defined as a deemed owner either if they're the person creating the trust, who would traditionally be treated as the grantor, or if they're a beneficiary who's a deemed owner under Code Section 678A. It's also important to note that these changes do not apply to non-grantor trusts. For any non-grantor trust, it doesn't matter when a transfer is made, there will be no change to the tax treatment of that transfer. Now, one notable difference between a non-grantor trust and a grantor trust is that any sales or exchanges between the grantor and the trust are subject to gain recognition and income tax relating thereto. So, as a note of caution, I want to remind you that any conversion of a grantor trust to a non-grantor trust creates a taxable exchange if there was a previous sale and a note is payable from that previous sale from the previous grantor trust to the grantor. One significant change is to treat a grantor trust like it's a revocable trust with respect to distributions. Now, as a reminder, this change only applies to irrevocable grantor trusts. Currently, And after the enactment of the new law, grandfathered transfers will not be subject to gift tax on distribution. However, non-grandfathered transfers, when distributed from the trust to a beneficiary, will be subject to gift tax at that time unless those assets are distributed to the grantor or grantor's spouse, which is an exception to that gift tax treatment. When a grantor trust is converted to a non-grantor trust, as I mentioned a couple slides ago, there could be income tax effects to the grantor. That doesn't change with the new law. However, conversion may become a gift tax event under the new law. Grandfather transfers will not be subject to gift tax upon conversion of a trust to a non-grantor trust. However, non-grandfathered transfers will be subject to gift tax on such conversion. Once again, the gift tax amount will be subject to offset for any previously reported taxable gifts comprising non-grandfathered transfers. This is an illustration summarizing some of the key changes to grantor trusts, breaking it down by grandfather transfers and non-grandfather transfers. As you'll see, the biggest change is in the gift tax and estate tax treatment of non-grandfathered transfers, because those types of transfers will be subject to estate tax at the grantor's death and also potentially gift tax with respect to the grantor if the assets are distributed or if the grantor trust is converted to a non-grantor trust. One change from an income tax perspective is that the grantor is still the deemed owner of non-grandfathered transfers for income tax purposes. However, sales or exchanges of non-grandfathered transfers between the grantor and the trust will be subject to income tax. Now that we've discussed these reforms, we don't know whether they'll actually be enacted as law. However, we do know that the effective date could be the date of enactment of a new tax bill, which could happen in a matter of weeks. So because of this urgency, there are some action items that can be taken. First, it's important to identify any irrevocable trust that you or a client might have set up that might be a grantor trust. These include trusts such as ILITs, SLATs, BDOTs, BDITs, GRATs, CUPERTs, and grantor charitable lead trusts. Once any grantor trusts have been identified, it's important to identify any non-grandfathered transfers that may be made after the date of enactment. If those are identified, it may be a good idea to make those transfers prior to the date of enactment of any tax reforms we've discussed. One common example of this would be annual or more frequent insurance premiums paid by an ILIT. If the grantor has to contribute assets for purposes of premium payments, it might be a good idea to accelerate those to the current date in order to avoid any non-grandfathered transfers, at least for a time. Another option is to explore converting a grantor trust into a non-grantor trust, especially if there could be any non-grandfathered transfers in the future. In some cases, this conversion may be as simple as having the grantor or a trustee release a power. In other cases, decanting or modification of the trust may be required. And that decanting or modification or the conversion itself, as we mentioned, could have adverse tax effects regardless of these reforms. For those grantor trusts that have an existing outstanding note that's payable to the grantor, you may want to explore having that note forgiven in part or paid off to the extent possible in order to avoid any issues that could pop up in the future with respect to conversion of the grantor trust after the effective date. And on that note, if the grantor holds a swap or substitution power with the grantor trust, then that power can be released, and it may be worth it to maybe exercise that power prior to the effective date, because any exercise of that power after the effective date, even with respect to a grandfather transfer, would be treated as a tax event. Thank you for joining me for this presentation on potential reforms to grantor trusts. If you'd like to receive any supplemental content, such as client deliverables in the form of video or email, you can receive those and other updates by subscribing to my newsletter at griffinbridgers.substack.com. On that newsletter, I provide a lot of content on tax and estate planning in general, and I also provide a lot of video content on YouTube. If you simply search my name, Griffin Bridgers, on YouTube, you can find that channel with over 230 videos on various tax and estate planning subjects. If you'd like to contact me directly, you can do so at griffin.bridgers@gmail.com. I'm happy to be a resource for education and media needs in the field of estate planning and tax. As a reminder, I cannot give tax or legal advice in response to your questions, but please reach out to let me know how I can be a resource for you. Thank you again, and I look forward to serving you in my future content.